So today's episode comes from a recent workshop that I co-hosted with Paige Kehoe. She's a local investor and also real estate broker. So a lot of investors come to us asking questions about passive investing and syndications. They want to learn more, and some are ready to make their first investment. So we put this workshop together with that investor in mind, someone who wants to learn more and potentially invest in a deal. Now, the best way to talk about how passive investing works is to go through real deals. So during the workshop, we go through 4 investments that I have been a part of, either as a limited partner or a general partner. The first is a multifamily value-add deal here in Denver. The next is a ground-up multifamily construction in Wash Park. The next deal is a land development opportunity here in Denver. And the 4th deal we talk about is investing in private credit funds for higher cash flow. So from a high level, we go through all the deals, why they make sense, the numbers, and how investors get paid and the type of returns they can expect. Now, I also share a lot of my own personal journey transitioning from an active landlord more into passive investing, both as a limited partner and as a general partner on various deals. So look, if you're interested in learning more about passive investing, then definitely check out this podcast. And if you want to learn more and actually go walk some properties, make sure you email ir@propertyllama.com. At the time of recording this, we have a couple property walks scheduled for some various multifamily properties in Denver and also Colorado Springs. So email us if you want to get access to those property walks. Otherwise, enjoy the show. We will be discussing 4 deals. Some are active, some are past, but we're just more featuring them to talk about them and discuss how these bigger deals work on the real estate private equity side. It's not an offer solicitation. And of course, we're not giving any financial and legal advice. So always go out there and make sure you're talking with your own professional team, CPA, financial advisor, lawyer before you make any decisions. And we are going to be sharing a lot of data and numbers. And so this is stuff that we've researched. It's, sourced from us, our partners. So we feel confident in numbers, but always do your own due diligence on the numbers.
We'll even tell you some due diligence things soon. Cool. As we mentioned, we're starting with the basics, and Chris is going to intro us into what private real estate equity is.
Yeah, so real estate private equity is a really fancy word for saying syndications or passive investing, which is a lot more familiar with people know. And the easiest way to draw a parallel is if you do traditional investing. Can you hit the next slide, please? A lot of us, I got started out this way, Paige, and a lot of people on here as well. You go out there and you find a property, right? Go find a single family home. On the MLS, from a wholesaler, you do a marketing, you find a property. You have your funnel, you sort through a lot, you underwrite it, you put your offer in, you negotiate, you get under contract, and then you're finding the property, you're running the property, you're putting down the down payment, you're securing a loan, and then you're personally guaranteeing the loan, and then you are managing the property or you're managing the property manager, but you're really in control of the whole property. So you get all the upside and also all the risk. So it's a really good model. So real estate private equity is the same concept. It's just at bigger scale. We all go out there and buy a single family home, buy a 4-plex. Now going out there and buying a 100-unit or 200-unit apartment building, that's usually beyond an individual's personal skill set, scope, and also financial ability. And so what real estate private equity is, you have investors on one side called limited partners or LPs. And what they are doing is they are investing into a bigger deal. So say a 100-unit apartment building that may cost, 10, 15, $20 million. And then so it's a way to access bigger deals that you can't do on your own. Now, since there are bigger deals, you have general partners, and they're the people actually running the project. And so they're doing 2 things. They're putting their own money in the deal because they're investing in the deal as well because they believe in it. But they're also the active partner in the business who are going out there and finding a deal, managing the deal, and running it. So a very simplistic analogy is, I say it's almost equivalent to investing in the stock market where, hey, you may own a piece of Apple stock or Amazon stock or, NVIDIA stock, but all you have is you invest your money and that's all you have in there. It could go up, it could go to zero. but you're not responsible for management of any of the company or responsible for anything. So private equity is a very similar concept where you're investing in there, either on this side or this side. And if you're this side, you're investing, but you're not part of the management. And then you might be like Matt, where he's doing some of these deals you're in Alabama, right, Matt? Yeah, so he's doing some of these bigger deals in Alabama where he's the general partner on some of these deals. And he's the one finding and running the property. And he's got a few investors in his deals. Any questions on that? Cool. And so
Go ahead.
Oh, I was saying, I think the next slide has
GPLP.
Actually, can I help us?
Yeah.
Are you able to be both
Yes.
at the same time? Okay.
Like in the same deal?
Yes.
Yes.
Okay.
Yeah. And so usually what happens is like the general partner, they're the one like putting everything together, and they are investing their own money alongside essentially as limited partner. And so yes, you can be both. And so the two key terms here are GP, general partner, and LP, limited partner. General partner is the person that's running the deal and they're taking the risk. And then limited partner is all you're doing is you're putting your capital at risk. You're not involved. You have no personal liability and you have no management risk. You could lose all your money, but that's what you're doing there. And the next slide gives a much more detailed breakdown. Won't read it all off on here. But you can see the general partner over here has a lot more of what they're doing. They're the ones that's running the market. And they're usually like anywhere from like a 5 to 30 person business as you kind of get bigger. So, these are businesses, running the projects, but they're finding the deals, managing the deals, negotiating the deals, working with brokers, networking, doing the due diligence, doing their financial analysis. They're arranging financing. A lot of times they are personally guaranteeing the debt, meaning that, hey, if something goes sideways, it's their name, their home, their finances on the line. And then they're ultimately in charge of operating the property, managing the property, and then just running the whole thing. On the other side over there, limited partner, your job is essentially like, hey, make sure you like the deal, and then you write the check, and then you don't have any of these other responsibilities.
So the rest of the next section is where we're talking about kind of like the life cycle of what a limited partner, what that looks like. As you can see with the difference in things, this is really why passive income investing is like so valuable to folks, because I don't know about you, but I don't necessarily want to be doing this every single day, but writing some checks and getting some money in the mail is really the value of passive income investing. But there's a lot to it. And so we're going to try to distill some of the terms. Some of them, if you're already running as a GP, Matt, you'll probably already know some of these. But we were just going to go through high level terms. And then when we start using those to define a couple of the deals that Chris is going to walk through, you'll have at least heard them once or twice and know that you're not alone. And sometimes it gets very jargony very quickly. Two of the things that you'll hear a lot is accredited investor, non-accredited investor. Accredited is an SEC term. It is defined by the federal government. We don't make the rules. We just need to abide by them until you hit these milestones. And you can look up on like the SEC site to see that. You have to be a little bit more creative when you're investing in passive funds. One of the really interesting things that Chris and I were talking about today is you don't have to be accredited to be a GP, which is also why as an LP, you should probably do your due diligence. But you can invest, you can invest in debt note investments. We'll walk through what that is later. You can invest in select larger deal offerings. Sometimes we'll have like a multi-tiered offering structure where a non-accredited investor can contribute funds. And then sometimes through your network, if friends and family deals and that sort of thing, you can also invest. Questions on these terms?
And I'll add something on here too, because if you, at least I see a lot of ads on Facebook and online for bigger deals. If you see ads online or ads anywhere, that pretty much means you have to be an accredited investor. Non-accredited investors, a lot of times they're structured differently legally, and that's much more, hey, you can be non-accredited if you have a personal relationship, but you generally can't publicly promote those deals. So if you're not accredited, the best way to find those deals, as Paige says, like through networking, of like, oh, hey, someone that has a deal and they're, depending on they're structuring the deal. Oh, you have an existing relationship. They're putting a certain offering out there. If you're a non-accredited investor, that's the best way to access those deals.
Questions? Cool. So when you get all the docs on a real estate private equity investment, a lot of times you'll hear everyone talking about these main terms. These are some terms that folks use to evaluate how well a fund could perform for them. You'll hear a lot of people talk about cap rate, even in traditional real estate investing. So I'm not going to go into too much detail on these ones because you do hear them a lot when you're just a 1 home, 2 home, 3 home, single family home or multifamily home investor. But they also do translate over to private equity for real estate. One of the things that I've noticed also sometimes on different offerings, they'll talk about cash yield, which is actually just your cash on cash return. Question about those ones, probably semi-familiar.
And when we walk through the deals, we'll dive into
We'll talk about all these numbers.
examples.
We were just showing you where they come from. And then one of the ones that's slightly newer for folks who come from traditional single family or multifamily investing, MOIC, I've also heard it called multiple equity multiple of money, all lots of mouthfuls. It's basically how much your money is going to increase by the multiple. So here's the example you'll see, like you put 100K into a project, you're going to get 300K in returns. The MOIC is 3. That would be a phenomenal deal.
Well, that depends. Are you getting them back in 2 years or 20 years?
True. It doesn't take into account the time horizon versus IRR does, which is, this was the literally only asset I could find online for this. So I'm sorry, it's quite grainy, but this just shows how much folks are not actually getting the correct information, in my opinion, on real estate private equity and such. So here you'll see it's a 1-year time horizon. So you have like this really high IRR and a pretty decent MOIC. But IRR does take into account the time horizon. And so that's something when you're looking at deals, you probably want to think about both and, evaluate that against your personal time horizon, which comes to liquidity and all these other things. So one of the things that is less nice about real estate private equity is it is not as liquid as other investments. If you write a check for 100K to a fund manager, you can't then be like, okay, I want to sell the fund. And it does depend on the deal. There are some funds in the partnership agreement that allow you to, what's the right term? Do a capital call, but not from yourself. Yeah. Anyway, get your money back out. But it's generally with a penalty, and I wouldn't go in expecting to do that. At the top, we've got the waterfall structure. This varies fund to fund. It will be defined in your limited partnership agreement and all the documents you get. You get a lot of documents. And it does show the order in which profits are distributed. Something that they'll also talk about in that is the preferred return, or the pref you'll hear. And it's also in this very long document that you get. And it's the threshold of return that investors are entitled to. Usually there's like a waterfall structure. It kind of looks like this. You'll see it in a pro forma or a picture. And, as money comes here, we have a picture for this. Why am I telling you this? The money falls down the waterfall. Time horizon is the length of time to hold an investment. Again, these all vary, but these are all things you should make sure that you're clear on before you're investing into any sort of fund or asset, because you are not in control of these. It could also be an upside because you can get high upside, but this is the difference between I'm going to buy a home down the road and rent it to someone. Things to add.
No, I think the diagram will help a lot on here.
Yeah, I'm like trying to explain to you. So here is an alignment of GP and LP interests. We have delightful diagrams from Google. The LP will get the preferred return before the GP earns their profit share. So you see, like, this is all the profit that comes, and they're getting 70%, and then it flows over to the GPs next. And like I said, this is a semi-good traditional model that you'll see a lot, but it varies a ton. And so sometimes I feel like people also will just call it a split. You'll hear that as well. But that's something important to look at to understand the GP-LP split when you're investing. Because obviously as an LP, you want more profit. Unless you're Matt and you're the GP, then you want...
Does it always flow that way?
Does what?
Does it always flow that way, or does it flow the other way sometimes?
What do you mean?
Through the GP first.
Generally not. So this was a hard concept that took me a couple months to wrap my head around when I was first investing. So a lot of preferred returns are set around like 5 to 10%, a lot are like 8%. And they a lot of times do that to kind of mirror what the stock market return will be. Historically, the stock market's around 8, 9, 10%. So what that says is before the waterfall or the split goes, you get your, let's say it's a 10% preferred return to Paige in this investment. So we have, Paige will get her 10% return per year. And that's not guaranteed, but the first 10% goes to her. Anything above the 10% then goes to the waterfall. Well, she'll get 70%. And then the GP, say it's me, I would get 30% of profit. And then, as you get bigger and farther on, sometimes the split will increase to where the GP gets a little bit more of hit certain thresholds. And so it's a really good way that helps align interest where, hey, the GP doesn't make like any profit until they return like a basic return to the investor. And the better the deal performs, the more profit they make. So typically that's how most deals are structured. Now you can structure it any way you want to, but I can't think of many deals that aren't structured around this, around usually a 5 to 10% and 70-30 or 80-20 for the waterfall is very common. And as you hit certain thresholds, it'll go 60-40, 50-50. So the GP makes more money.
I've seen some that invert.
Yeah.
As they hit like the higher thresholds?
Yeah. Hit like a 3 times equity multiple and then
Yeah.
70% to the GP and 30% to the LP.
I've seen a lot of the advertised online funds that are more 60-40, which is why you need to make sure you do your due diligence.
Is it possible for the LP to not have the preferred return? Like, you do this deal, there's no preferred return at all.
There are some deals structured like that, but the vast majority have a preferred return with them. Which again, that's not a guaranteed return. It's just saying, hey, you'll get paid this first before the GP makes any of their profit.
Okay, so say the deal doesn't go well, the return is only like 4%, just say, and then the LP can only get 4%.
Yes. And the GP gets nothing.
Yeah.
Okay.
Yeah.
Okay.
So if the deal is not performed, the GP gets nothing.
Okay.
Typically.
Cool.
Yeah. Again, this is where we'll talk about later, but like, understand all of it. And then there's 100 to 200 pages worth of legal docs. Read the legal docs and then understand them.
Questions around kind of just those terms, high level.
Yeah.
The most typical deal structure. Again, it does vary. We're going to go through a couple other ones with examples.
And to keep it like very simple is like, you kind of get the first 5 or 10% and the rest is waterfall is a fancy term. I think of it as like a profit share. Hey, once it hits a certain profitable, point, the business owner or the active partner in there starts getting a piece of the pie, which is what you want because if they don't make any money, they don't care about the deal, which is not good for the LP.
Some general rules of thumb before we go into kind of what the process looks like. Again, generically speaking, we say it's your own money. You can do whatever you want with it. But a rule of thumb that I use is not more than 10% of my net worth into one deal, mostly because that's pretty risky. So then you have, an outsized investment in something that you don't have control of as an LP. And then again, do your due diligence. We'll go through a couple different things that we recommend for due diligence, but it can be anything, right? Like you can call up people, you can look through past deals, you can get references. You definitely want to read the very long doc. But these are our 2 big rules of thumb that we wanted to talk about too. Yeah. Okay, that was the terms. Now we're going to walk through the process. So this makes it sound really simple. Again, each of these have their own nuances and variations, but from a high level, it can be quite simple. If you find the right opportunity, you evaluate the deal, you say, check, this matches my box for the returns I want and how much I want to invest. Then you send the money. And then when the deal goes well, ideally you make the money. First one is finding opportunities. We mentioned a couple already, but for the larger like online things, there's Fundrise and CrowdStreet and all of those where you can invest even smaller amounts in very large syndication deals.
Have you guys seen those websites before? Yeah.
The Amazon one where you can invest in single family.
Yeah, for
there's
like
some like
$5.
Yeah.
The return's crap though.
Yeah. So, I mean, It can be a good way to get your toe into real estate if you're new to it. All of you have at least some experience already. So what you'll really get the returns is when you partner with the capital group. Some of those are Property Llama, Chris's team. Open Door Capital is a big one that's touted through the Bigger Pockets forums, and then also networking. There are a lot of different groups in different asset classes, and there's a ton in commercial real estate as well. So you're kind of doing it right now also.
Yeah, networking is going to be the biggest way you find groups that, finds and runs the deals.
All right, this is where we get a little bit more ticky-tacky about all of the docs you're going to get, and it does vary. The things that you'll traditionally get, so say I found Chris and I was like, hey, I love what Property Llama is doing. Like, can you send me the OM on your, what do you call the 3-pack fund? Your 3-pack fund. And he'll say, okay, cool. Here's the offering memorandum, which is called the OM. That should have a summary of the property, again, specifically for real estate investments. The business plan, their returns, it will usually be a nicely created document because that's kind of the marketing for them. It should go through some of those key terms we talked about with time horizon, liquidity, LP terms, what the pref is, what the splits are going to be. And then also sometimes you'll get something around like a pro forma or a financial model. I personally have received actual Excel spreadsheets. Sometimes folks don't necessarily want to send you all of their Excel spreadsheet, but they should have a screenshot of, investor A invests 100K. Here's year 1, year 2, year 3, year 4. So you can see what you would expect to get. And then you'll also get, if you say, hey, I'm like really interested, you get the PPM. That's the 120-page document with the fee structure, the ownership structure. It gets very detailed on like Class A versus Class B, details about the pref, if there's going to be capital calls, which hopefully not. And then the subscription documents, and then how the ownership structure is, which is important for you to know who's running the fund. Other things that you find in the PPM that are important?
It just outlines everything. So if there's ever any issues, it should be outlined in the PPM and subscription documents. That's the contract, and that runs through the scenarios and how things operate.
And you'll find that some groups there's a couple different online tools that they'll use. I've seen InvestNext. What's the one? Do you use InvestNext?
No, we use a couple different ones, but those are like the portals that you can use to go on there. And
they'll have like the documents for each offering if they have multiple ones. And so you can look at those. And then also in the deal evaluation, this is what we recommend for due diligence. You notice we do have gut. Gut matters. If you're talking to one of the GPs or someone who's trying to get you to invest in something, you don't have a good feeling about it, I wouldn't
follow your gut.
Invest in that. I would say look for a strong team. You can usually ask for examples from previous deals. And so, for instance, I think I was at another presentation from a fund group, and they said, oh yeah, like we've done 4 more deals. The plan is to exit in this time. And we said, okay, well, have you exited? And they actually pivoted and did something else with the fund. And so it's interesting to see how that could play out. So you could plan for that scenario as well. I would say also make sure you're testing the conservative case. Again, everyone wants, 20+% returns. Sometimes market scenarios change. Sometimes government regulations change. Like, make sure you understand where your money's going, because once you send it, you're signing that document and it's hopefully going to make you more money. And then understanding if they have skin in the game. I think that's a big important one. You'll find, as we were just talking about, like sometimes GPs are also LPs or they've personally invested. And, chat with them, understand their communication, because not every group communicates the same. Like Chris does a really good job of making sure that his team is always getting in front of their LPs and letting them know what's updated. If something's changed, here's this. I've seen some groups that only send out like annual reports and that's it. And then you don't know if you're going to get a check. You don't know when you're going to get your K1 and all this tax stuff. And it's kind of stressful. So you want to make sure they have a robust team, however they communicate with their investors.
For the good stuff and the bad stuff.
Yeah. And not just like a 5-page PDF in font 8. Speaking from experience. Questions on evaluating deals, the paperwork you get, that portion of this process. Okay. Cool. So then after you do that, you send money. Usually it's a wire. And then, like we were talking about earlier, sometimes the minimums vary by fund. You'll see some funds that go as low as like 25K, some are like 250 or more. And then you also want to make sure it fits correctly into your financial plan and talk with your CPA. We can't give advice on that, but you should have a CPA. If you don't, I know a couple, I'm sure Chris does too. Please talk with them.
Are your CPAs actually taking on clients?
Ooh, that's such a good question.
That's the problem we have, right?
Isn't that the eternal question?
Yeah.
Yeah. This one's pretty, Then you're an LP. Woohoo, you did it. You will get your distributions if the fund is performing as planned. Typically, you'll see quarterly distributions, which is usually a wire or an ACH or a check. It depends on the fund. Sometimes you'll see annual. Sometimes you see monthly. That's kind of cool. And then you wait for the exit opportunities. Generally speaking, when you invest in the fund, you'll understand what their exit opportunity is, if they're going to refinance and pay back all the LPs, or if they're going to sell, or what's going to happen with your money. You'll be prepared for that, and they'll communicate with you about that. And then just remember, it is a longer time horizon. Like I would say the shortest one I've seen is 2 years. 2 years, 5 to 7 is common as well. So just realize you send the money and then you say, okay, cool. It's very different than when you buy the house and you rent it immediately and you get checks, but then you're also not going through the mechanics of purchasing real estate one by one. Questions about the process. That summarizes our high-level intro before we go into a bit about the market and then some deals that have happened recently with Chris's team.
Can you talk a little bit about how the depreciation works when you go into a multifamily fund a little bit?
Yeah. So, earlier we talked about kind of use the example of, hey, you buy a single family home individually or if you invest with others. Typically all the same benefits, pass through in the syndication. So, there's 4 ways of money in real estate. There's cash flow, monthly or quarterly cash flow. There is appreciation in market appreciation and adding value to just make the property worth more. And a lot of times if you're paying down principal on the loan, and then there's also the tax benefits or depreciation. And so, if you go out there and buy a multifamily syndication, a lot of times they'll have depreciation tax benefits. So that all gets passed through to the investors. Typically, always read the subscription documents to make sure, but the same benefits pass through on there, which helps, offset taxes you may owe that year.
Any other questions?
Do LPs know each other's name at all?
No, it's private real estate. So typically, the GPs, they know all the LPs, they don't share. Oh, hey, cool. Here's our 10 investors, 20 investors. They don't share that. That's private information. And so, sometimes you'll know like, oh, hey, we're investing in the same deal if you, in the same networking group or, you're in the same mastermind group, but that's not public information and it's generally not shared.
Like say if I'm interested in a deal, can I ask how many LPs so far you have? Can I ask that question?
Oh yeah, questions like that. Okay. Yeah. And then sometimes, most groups, people, I want a referral of other investors. Most groups don't do that just because they want to keep the information private. And so it really comes down to a lot more like due diligence on, on the group, the sponsor or the general partner doing it, and also the deal itself.
What if you cannot find enough investments for a deal? That does that ever happen?
Oh, that happens.
What's going to happen if you cannot find enough investments?
So that can go down some not good roads. So, it's a lot of it goes in with the type of deal and how it's structured. But a lot of times what happens is, it's always a balancing act of, hey, they want to go out there and let's just say buy a big apartment building, right? Hey, they find the apartment building, they get under contract. And then usually, they get past some initial due diligence on, hey, the inspection, the property makes sense. We want to go on there. And all of a sudden they go out there and they say they need to get $3 million worth of investors into there. And that's where they start then getting people to sign the documents and invest and then wire the money in. So most groups, they get the finish line on there, but I have heard of some horror stories where it's not happened. And then usually what happens, the deal falls apart and then you get your money back. But that's where you want to make sure the PPM because, hey, if your money you're investing is part of the earnest money, which is the good faith money on the property, I've heard of some people like actually losing part of their investment because the group a lot of times has to put up earnest money and then they go hard or non-refundable after a certain period. Most GPs use their own money for the earnest money. That way it's their money, not the LP money at risk. And this is where you want to like do due diligence. But I remember an operator out here a couple of years ago where he did not have enough money to like do his own earnest money. So he used investor money and the deal fell apart. I don't know why, but fell apart and the investors lost their money because he put the LP money as earnest money, which that happens rarely. But that is where you want to make sure to understand the documents and how the money is being used.
But did the LPs know that their money was put into us this money at that point?
I don't know on that deal. I don't. On one, yes, because that was part of like what he was doing. On others, no, they don't, or they didn't read the documents clearly enough.
You can also ask like how much they have subscribed already. So they'd be like, how many people have not people, but how much money of their target they've already gotten to. And so say they're raising 3 million, they're like, oh, we have 1.5 million subscribed. Like then there's only 500K left, which you would hope they could raise if they're a good operator or a good fundraiser.
So if I understand correctly, the earnest money is to kind of like put this deal under contract.
Yep.
And then you need some time to find investors.
Exactly. And so it's just like if you go out there and buy a house, in Colorado, a lot of times $5,000 or $10,000 is, hey, contract's accepted. A lot of times within 72 hours, you got to go drop off a $5,000 or $10,000 check at the title company. Exact same concept, just add a few more zeros to it.
Right, but do you have more time to close a deal in this situation because it's commercial?
Typically, because commercial properties take a lot longer to close. But then there are opportunities where sometimes the seller is in a bad position and they need to liquidate. And hey, if you can close fast, the group can close faster and get a better deal. But that's where then they usually they have their own money or they'll bring in like a hard money loan to finance part of it. And that's just part of like understanding the deal and understanding how the general partner is, funding things and where your money is at risk and not at risk. But most should not like have the LP money at risk at earnest money. Hey, if a deal falls apart, what's happened to us, it stinks. Everyone kind of wastes a lot of time and you lose money and just human capital. Money gets returned to people.
So what's a euro time period from being under contract to close the deal?
Oh gosh, I mean from weeks to 3 months is pretty typical.
3 months.
Yeah.
The longest is 3 months.
It can go longer, but I'm kind of giving you like the typical ranges.
Usually it depends on which side you're on, but I would say as LP, usually you have like month or two to decide to invest. But it super depends on the fund.
Yeah, but the seller is waiting for the deal to close, right?
Oh yeah.
Because they are going to be pushing you.
Yeah.
That one close fast. So
Yeah.
you need to find investors as soon as possible.
Yeah, and usually the sellers get into like that much detail, but that's where like the track record and the reputation of the general partner, that carries a long way to where they have, hey, this is not their first deal or their first rodeo. They've closed deals before, and so that a lot of times is what allows them to actually get access to the deal through a broker or usually there's multiple people trying to get the deal, and oh, hey, you've done this before, you have experience, you have track record, you've done similar deals like this, and you closed. I want to go with you, versus hey, Jacob's new on here. He's experienced. Experience usually wins because, hey, cool, you'll get the deal to the finish line. And that's again where it's so deal specific, it changes. And when you get into commercial properties and especially like private equity, there's just so many more variables than your typical, like, hey, you buy a house in Denver, 20 or 30 day close is very typical. A lot more variables and a lot more things go into there. And we'll talk actually more in a couple of deals on here and we'll kind of give you some more guidelines on there. So perfect timing. What's working in today's market? So I said in my intro here that I had built a good rental property here, or rental property portfolio here in single family. And so what this chart shows here is that solid line is single family homes. The dashed line are condos. And so this just shows total price appreciation or total value of the asset. So going back from 1973 to about 2023. So I highlighted where the 2006, 2008 great financial crisis happened, the GFC. And, if anyone was around then, either in real estate or in financial market, the world was going off a cliff. Well, when you look at that, it does not look like a cliff today. It looks like just, a downturn. And then we had this huge, just massive price appreciation and rent growth. And that really happened from 2010, 11, all the way up to about 2022. And then you can see here at the end, this is where COVID happened. And just, interest rates went to, very, very low. So a huge spike in prices for a couple of years. And then now we're at a point where things have flattened out once rates started going up. So a lot of us, made a lot of money by just, hey, we did some good investments, but also we had a lot of tailwinds with the market, right? The market just made most investors look like geniuses. And then kind of what happened now in the Denver metro and a lot of other markets is, I like to say the appreciation party is over. Where we no longer have the huge, 9, 10, 11% appreciation a year, the 5, 6, 7, 10% rent appreciation a year. The law of averages kick in. So now we're seeing very flat, and we've seen even some, flat, small negative a little bit here and there, but nothing crashing. And so while interest rates spiking have not caused a residential crash, they are causing that in the commercial market. And so this is a big reason why I shifted my investing more towards passive and commercial investing, because there's a lot more opportunities on there. As investors, we want to buy low and sell high. And so the green line on here are duplexes, triplexes, and fourplexes for multifamily. We can share these slides too. I see people taking pictures, so we can share these slides too and make it easier. Sorry. So this goes from 2007 to about 2023 here. And so this is for Denver Metro, and you see the green prices here, they dipped some in the great financial crisis, but not like the big crash we saw in residential. And then we saw good prices, good price appreciation. COVID happened, prices went up, and we saw prices drop a little bit in residential multifamily, duplexes, triplexes, fourplexes. But we have not seen prices drop a lot. Why? Because they're on 30-year fixed mortgages. I have a fourplex I bought in 2018 or 2019. And during the COVID years, I have a 30-year fixed at 3.5%. I don't have, it's crazy, and that will never happen again. Now this dash line, the black line on the bottom here, is actually commercial multifamily, so 5 units or greater. So when you look at commercial stuff, there's two important things to note on here. One is they don't get 30-year fixed interest rates like we do in residential. They'll a lot of times get anywhere from it'll float month to month till about a 5 to 10 year locked in period, with a lot of it being 3 to 5 years is very common. So they're a lot more sensitive to interest rates. And also the way those properties are valued is they're valued on the income approach, which is more of the business approach. How much cash flow, how much profit is this property making? Which is different than a single family home where people I want to buy this house because it's a good school district, it's near my job, I can take my kids to the park, that's where I want to raise my family. The multifamily and commercial assets are a lot more sensitive to interest rates. So you can see here, there was good growth, and then 2020 rates went to zero, shot up in prices, and then rates started going up. What happened to values? Prices started dropping. And so this is where we're seeing a lot more distressed. And so, we've been buying properties at 2019, 2018 prices. Anyone buying single family homes at 2018 prices? No. But some commercial assets, absolutely. And if you're an office building, which I am not in, office buildings, I don't know. You're buying them at 1970 prices in some cases, Does this make sense from a macro trend standpoint? Yes.
Is it because many multifamily are defaulting right now?
Some are defaulting, yeah. And so what happened is, it went from all these tailwinds of, low interest rate, and then big rent growth. So it made them very attractive. And so we had also interest rates go up. So if you're selling a property that you have at 4% interest, and I'm buying a property at 7% interest now, my mortgage payment's a lot more. But at the same time, what happened with taxes and insurance the last 2 years? I mean, they all went up 10, 20, 30%. And so those expenses then lower the cash flow of the property. So you kind of got this double whammy of, hey, rates went up, but expenses went up a lot higher because we had a Goldilocks phase where rents grew really fast and expenses stayed relatively low. Again, law of averages always kick in. And so expenses kicked up in 2 years, which have kicked up over the last like 5 or 7 years. And so with that, now people are like, hey, what you bought this place for, I can't buy today because I'll be, negative cash flow. It doesn't make any sense. So for me to buy it based on today's rate and today's expenses, I can offer you $200,000 a unit versus $270,000 a unit. Does that make sense? Great question.
Yeah. Any other questions about kind of high level trends? Does this make you want to buy commercial multifamily properties? Wow,
There we go.
so great, because that's what we're going to talk about.
So here's an example. This is on Samuel Drive in North Denver, and it's a multifamily value add deal, which is a really common example. This is essentially, do you guys know what burring residential properties are? Buy, rehab, rent, refinance, repeat. Same concept here. We want to buy a property. You can add value to increase the rents. And so this is a property that we purchased November of 2022. So we bought it as the market was going down. So a little bit of a, catching a falling knife, but bought it, at around the 2020 price. So that's where we bought it in the macro perspective of the Denver market. And then it's a 34 unit building, but it's two 17 unit buildings. And so these are very, very common examples where this investor's owned it for 20 plus years, and then they get landlord lazy, or, the husband, who's usually a lot of times the main manager, they pass away, and then the wife and kids are managing it, and they're not paying attention to it. So there was a lot of room to raise the rents, about 40 to 60% in raising the rents. And also it was just needed a full rehab, where the units were 1980s vintage. And so it's a lot of 1 bedrooms, a couple 2 bedrooms, but good location where it's close to light rail and about 15, 20 minutes from Denver. And so the plan here was to buy the property, renovate the exterior, basically remodel all the interior units. We budgeted about $930,000 for their construction cost. Actuals came in like about, I think, 810 or 820. And so this is a very just classic business plan for multifamily. And you can see here, ultimately, and this is what matters, is we could raise the rents from about $1,815 per average per unit to about between $1,300 and $1,400 per unit. And actually, they came in about $1,350 per unit, so right in the middle of what we were anticipating. So here are some before photos. So again, the wonderful properties that a lot of us have lived in and seen. And then this is what it looked like afterwards. So, new cabinets, new appliances, the luxury vinyl plank flooring, full makeover, updated the exterior. A big thing now, especially in Denver, is added a little dog park there. I mean, you guys know how many of us have dogs, how many of our tenants have dogs. And so do a lot of community amenities out there as well to clean up the property. And so what this deal should do is anticipate about a 15 to 18% internal rate of return. So that means if we held it for 2 years, you should make about 15% per year on your money. And so a little bit of cash flow, but since this is a shorter term hold, this is kind of like how we adapted to the Denver market. And the Denver market's usually, hey, if you can go out there and increase the value, you can usually sell pretty quickly. So it's more of a multifamily flip with, a 2 or 3 year hold versus like hey, fix it up and then take cash flow for a couple of years. And so coming back to here, this is where I want to go back to like the waterfall split. I forget the exact pref we had for the investors in there, but it was in that 5 to 10% range. And then there was a split with a general partner on there as well. Hey, once it hits the pref, hey, we keep a lot of the upside as the LPs, and then the general partner keeps, part of the profit as well. Any questions or comments on this? how we find the property.
Yeah.
So the person we partnered on here, the sponsor on here, they've done 40 or 50 apartment building deals. And so with commercial multifamily and commercial properties, those are controlled by commercial brokers for the most part. It's either commercial brokers or if you've done some really good networking. So commercial brokers, they spend a lot of time working with owners. And then when they find a deal, they usually know, hey, what investors have done deals like this before and can close on the deal, and they'll call those investors. So they knew that, hey, for deals like this, where it's a smaller, I say smaller, 34 units. It's a Class C area, transitioning some, but with with the type of work it needed, the speed they could close on, they went to our partner and said, hey, do you guys want this deal? And so a lot of times it's the broker who's calling around and shopping it to their select investors. And so we were just,
Are you the GP in this deal?
this one, yes.
Oh.
And I didn't find the deal, more just on the investor relations, helping to bring money to the deal. The total money needed was about $2 million or $2.1 million. And we brought about just over $1 million to it. And so we brought about half the equity to the deal. And so it's just someone I've invested with for, many years, and he's a really good operator on here.
So it's because you only bring half of the money. So what about another half?
Well, that's where he came from. He has some of his own investors as well. So he invested, I think, $200,000 himself, and then the other money came from the other investors. So it all gets pooled together, and we all basically get the same equal share of, the 10% return. It's all pro rata for the money we put into it.
Okay. So when you say he's the contractor in this deal?
No, he's what's called the sponsor. So so they're usually general partners. There's multiple general partners. And so he's the one finding the deal and is running the construction on there as well. And that's his role he did. And so for this deal, going back to your question, we had about 4 weeks. I think about 4 weeks, right, Richard? Give or take a week, 4 or 5 weeks. So yeah, 4 to 6 weeks to actually bring the money to the deal to get it closed in time. So this was, I think, like a 4 to 6 week capital raise.
The really good deals usually close really fast.
Yeah.
Mm-hmm.
How far down the road are you on this project?
So this project is completely renovated. It is, everything's done. Construction is complete. All the units have been renovated. All of them are at that market rents, like in the high 1300s now. Now the plan was to sell it this year, but just between the market conditions, things got, worse than we anticipated. And also some of the legislation the last couple of years have not made things friendly. So we're not able to sell it this year, but we should be able to sell it next year at the price we want. So it'll turn more into like a 3-year hold versus a 2-year hold.
So do you have tenants in those buildings right now?
Oh yeah.
The same tenants or new tenants?
New tenants.
Yeah.
Mm-hmm.
Usually what happens is, so these were, it's a dilapidated building. Tenants were paying, about half what market rent is. And a lot of times owners, it's amazing. They own a multi-million-dollar asset and they have no leases or, very poor leases. They don't do background checks. And usually what happens when you go on, you start, you have properties that aren't cared for and in poor conditions. It attracts different types of tenants. And when you go on there and update it, put security in there, put lights out there, start raising the rents, most tenants leave because they want to find a cheaper place and a place that is not as nice, to put it politely. Some tenants will stay there. They're so grateful and appreciative that the property's been updated. I love it. Thank you so much. So some tenants did stay there, but the majority left. And so new tenants came in there with it being an updated, renovated place and a much, safer, nicer place to live.
So from the beginning, your plan is to renovate the whole building
Yep.
and sell it, and all the OPs know your plan.
Oh yeah, we had the full subscription documents, the full offering memorandum, and talking about the time value of money is we should sell it for what we want. The problem is we'll take probably a year longer to sell it, so the internal rate of return will be a little bit on the lower side than we anticipated. I think it'll probably be around 11 or 12% versus the 15 to 18%. Just because we're holding a year longer than we anticipated. And that was just because the market got a lot tougher than we had planned.
can you change the plan though? Can you tell the investors, okay, right now we're gonna hold even longer?
Oh yeah, everyone knows that, and it's built into their, hey, we can, hold on to it, extend it, and we're going to sell it when it makes sense. We all make, the best profit possible.
They'll usually have like contingency plans, and you can ask about that when you're evaluating the deal. You can be like, okay, so, say you aren't able to get the tenants out. Are you just going to hold it until you can renovate the whole thing? Are you going to do unit by unit? And they should have the details of that plan. If they're a quality operator and sponsor, they'll be like, okay, yeah, this is our plan. We've bucketed in, a year potentially, especially with new Denver tenant laws, maybe not a year, but a certain amount of time to transition tenants. We've bucketed in this much time. Like you saw, they budgeted more for construction costs than they actually needed to pay. So the pro forma and all the information you get at the beginning is usually supposed to be the best guess of a realistic, but it can go higher or lower, and each deal is very different.
And all those contingencies need to be in the subscriptions that are given? Or?
Typically, you'll get there's a balance. Like you kind of get like, hey, a lot of times like, hey, here's plan A, here's plan B, here's plan C. And so it's not going to be like super detailed for everything, but you have like the high level so you know how the scenarios are laid out.
Yeah. I think also as an investor, you wouldn't want them to sell right now because you couldn't get the right amount of money for it.
Yeah, we put on the market over this year, and we had some offers, but they were $300,000 or $400,000 less than we wanted it to be. So we're like, well, let's just wait for rates to drop. And also, commercial properties are way more sensitive to the election than than residential properties. People just get, if I can speak very frank, stupid around election time. And so it just makes sense. Hey, we'll get past the election, rates will drop, and then Q1, Q2, this should hopefully sell.
You're mic'd.
Yes.
You just said everyone's stupid.
Well,
cool. So here's another one that's also around multifamily, which is an asset that a lot of you seem to have an understanding of. This one has a pretty phenomenal location in an area that some of you probably drive by.
Yeah, so this one is right on the border of Platt Park and Wash Park. So this is a ground up development play. So not a value add, we're buying existing asset, but going out there and building a new one. So this is obviously like a 3D rendering of the project. And so to get more detailed on here, this is actually what's called a covered land play. So there is an existing multifamily property on there that's 20 or 22 units that needs to be updated or knocked over and torn down. Well, since this is around the border of Wash Park, Platt Park, that is obviously a grade A location, amazing area. An old building, rather than updating it like we could on Samuel Drive, the highest and best use of the property and the location is to knock it down and build a new place. The nice thing about the covered land play is you buy the property, there's existing tenants and existing cash flow on there. Because development takes a couple of years to get through all the paperwork to get things ready to go. So the covered land play actually brings in cash flow to actually reduce the expenses during that time frame. And so this should break ground, I think early next year. And, we won't go through all these numbers, and we'll share these slide decks if anyone wants to see it. But you can see it's actually 1000 South Logan Street. The existing building on there is a 20 unit built in 1938. And the proposed new building should be around 65 units. And then coming down here to some forecasted numbers, you can see the forecasted hold time is 10 years. So it's a longer hold time. Now with deals like this, a lot of times development, they want to read the details. Like in this property itself, most people will be invested for the 8 to 10 year time frame is what we're anticipating. But once the property is built and stabilized, there will be an opportunity for people to exit if they want to around the 3 or 4 year mark if they need the money or they don't like the way the deal's going. And that's pretty common development is you can sometimes have exit points when you hit certain milestones, usually once the building is built and it's up and running. But this is another play that works really well in Denver, a lot of their markets of, hey, build in a great location, and then you can command premium rents because you're in Wash Park area.
This is a good example of what you would get if you asked for like the OM of this deal. They would send you the offering memorandum and it would have all this info. Like this is straight from that.
Yeah. And you can see it was a $4.1 million purchase price. They're expecting about $1 million in design and entitlement cost. And they're going to take out a $2 million land loan And then they're going to go through all what it takes to go out there and actually, build it. And it's about a $21 million projected construction cost. And altogether, I think it's a $32 million, total deal, with some coming from equity, the limited partners, and a lot coming from bank for debt financing. An important thing to look at too is, the loan to cost, which is essentially like the loan to value on the property. They're doing 65%, which is, fairly common on development projects. And also it's on the, I'll say, more conservative side on there because there's buffer, not over leveraged on there. Now you'll see some development deals that are 90% loan to cost or 90% loan to value. So you'll get a higher return, but it's also a riskier investment. And so it's items like that we have to go in there and look at what makes the most sense for like, hey, great return, but also like what's a great risk-adjusted return. Because every deal is risky, but there's certain metrics lenders can pull on there to like de-risk the property and hopefully find that sweet spot. And so as Paige said, this is like one page of about 30 pages on the offering memorandum that actually goes into all the details.
Question?
So with holding it longer, are you going for appreciation on this one?
Yeah. So what this is really two things. There's like the forced appreciation, which is, hey, building a new property on there. So a new 65 unit apartment building is going to be worth way more than a 1938 20 unit apartment building. So majority appreciation comes from there. Then the second part of it is, hey, you hold it, longer term, rents grow. And as rents grow, that will also increase the value of the building. Yeah, Richard.
Yeah, there's also one other thing with development. You get a lot of the forced appreciation yields like much better cash flow.
Yeah.
Because it's called unlevered yield on cost. And so this thing is going to cash flow like 8 or 9%, which is very high. So like even though you're holding it for 10 years, I think their average cash flow is like very high single digits, very low double digits. And so you're collecting very good profitability and also on hold. There's also several good finances, so you get some of your money back or you get cash. It's a very common development.
Yeah, so Richard brings a great point in here. So usually around year 3, you should start seeing cash flow because cash flow is not going to happen until the building's built and tenants are in there. And so I think around year 3, anticipating start the cash flow distributions, and then around year 4 or 5, doing essentially a cash out refinance. And so they can, pull out a lot of the equity from the appreciation they forced in there, and then you'll get like a big lump sum in year 4 or 5. And since it's a refinance, that's not a taxable event. And then that gives you like a big one-time lump sum cash flow in addition to the 8, 9, 10% cash flow. And then sometime around 8 years, 8, 9, or 10, sell the property and then get the big exit from, when the property sells.
You'll see this one. It says the equity investment receives a 12% accrued return paid at closing of the construction financing. So that's when you can stay in the deal or continue going. And so that's part of that's your like exit option if you wanted it.
What is the forecast deal level returns? How is that different from the LP returns?
So that is where the waterfall profit split comes in on here. So what he's asking about right here is like at the deal level. So this is saying at the pure property level, expecting a 15.4% IRR and a 2.7 MOIC. And so that's like, hey, the deal itself, that's what it should produce. The limited partner return is what the limited partner is expected to get. If the deal goes well, after the general partner takes their profit share or their portion of the waterfall. So a lot of times they'll show that to be transparent. So you can say, hey, here's what the deal is projected, and then here's what you should make, and then here's what the GP should make. That was a great question.
Other questions on this one? We've got 2 more deals.
Just as an example, that IRR at 14.8, is that compounding? It's got to be in order to get to the 2.6 MO.
So IRR is, it's something you actually can't calculate by hand. It's all like a spreadsheet calculation on there. And so what IRR does is it takes in the time value of money of like the timing of cash flows. So, it's saying, basically, year 1, you have your big check going out for $100,000 or $200,000 going in the deal. Years 1, years 2, into, year 3, you're making no cash flow. It's just 0, 0, 0 because they're building the building. Year 3 or 4, you start getting some cash flow. 7%, 8%, it should grow a little bit. And then come around year 4 or 5, you'll get a big lump sum back from the refinance, maybe 30 or 40% of your original investment. So you'll get a $30,000 to $40,000 check back in year 4 or 5. And then you'll continue to get cash flow distributions 5, 6, 7, 8. And this will sell sometime between like year 6 and 10, most likely. And then you'll get a big lump sum back there when it sells. That's when the bulk of your return will get. So IRR is taking all these projected timing and cash flow and then calculating based on because, hey, $1 today is worth more than $1 tomorrow. And it does some discounting for, hey, $1 today is worth more than $1 in 10 years.
And you would there'd be like a pro forma or a screenshot of a spreadsheet where you could see that actually played out to how they calculated it usually. I usually look at that more than the IRR. Like, it's a good number to look at, like, oh, this fund says this IRR, but for like at least my investment thesis, it's not the best metric for if I'm going to invest in something or not. But people love to talk about it.
Yeah, I love IRR. That's my favorite metric. But that's where it's like no right or wrong. That's just what I love because that's, I think, the truest form. Like, hey, how hard is my money working for me? And so for IRR, like, I definitely recommend, like, that's a good thing to go spend an hour on Google and like YouTube University on because it's a really complex topic. And you can find some, like, you can build your own Excel calculator. There's a lot of calculators online. You can plug in like different values and like play around with it to understand how it works. All right, so third deal, and this is another deal in Denver. So 3600 South Ivanhoe. And so this is a land entitlement deal. So this is right south of Hamden and just west of 25. So it's a great location. It's in the Southmore Park neighborhood. So I think the average home price here is like $2 million. So it's a really, really good neighborhood. But what it is here, it's this piece of land that looks like Oklahoma. So this is Thomas Jefferson High School. And then this is a piece of land that we bought from the Hebrew Educational Alliance or Education Alliance. They own the land and then they are looking to sell it. And so why we love it is it's an off-market opportunity that just, got a really good deal off of there from a broker. And the broker called Narrate, the general partner on the deal, and said, hey, we got a great deal. And Narrate scooped it up. Now, also got very attractive seller financing. They've owned it for a long time, and they can really give really good financing. So they're getting $2.5 million in seller financing at a 6% interest rate with 3 years being interest only, meaning, hey, for 3 years, only interest payments, no principal payments, which, that lowers the monthly outgoing expenses. So really good location. And then the plan here is not to build a multifamily to rent, but it's to take this piece of property and then subdivide it into lots so they can build single family homes, so they can build it and then sell the homes to homeowners. So here is what, it may look like. They're still going through the details on here of building some townhomes on the top part and then some single family lots on the bottom part. And so this is a cool deal where there's optionality on here. Now, the forecast IRR is about a 47%, which is, extremely high. But that's over an 18-month period, so it's a shorter time period. And so plan A, if they can execute it, is they're going to subdivide the lots and then not build, but they'll sell off to builder. And so it's a quick in and out, relatively speaking. And then that should be a 1.8 multiple on capital invested. Now, if plan A does not work, then plan B is they'll build the properties themselves. And we don't have those metrics up here now. Then that turns into like a 3 or 4 year hold and then a lower IRR, but a higher return on capital or multiple on capital invested. And that's because time value of money, it's a longer hold time frame. So this was actually a deal we started putting together late July, early August. And going back to your time on a question here. So everything was ready to close, raised all the money, which was about $2.2 million. And then right before it closed, or about to close, something came up and it's delayed the closing. So it hasn't closed yet. Now all the money is sitting there from the investors. I've invested in it. I know Caitlin invested in it. Christy invested in it. I think even Paul invested in it on there as LPs. Now, going into more details on it, the general partner narrate, their earnest money has gone hard. And they did that to keep the contract extended because they're like, hey, we want to sell this, but then they couldn't deliver the title the way they wanted to, but they wanted a good faith from the buyers. But narrate put their own money at risk. So let's say if the deal falls apart, we get all of our money back. Now, the general partner, they'll lose their like 100,000, or I can't remember what the amount is for earnest money. They'll lose that money, but we won't. And that's the way it should be structured. That way, none of our money is at risk. But that was, hey, this is going to close really fast. And then there's a hurry up and wait situation, which is pretty common for commercial real estate.
Okay, the last one's one of my favorites. If you've ever done flipping, this one will maybe like resonate with you if you've worked with hard money lenders. But this is the one Chris calls Be the Bank. Yeah, and so this is where, there's, I've always invested most of my years as had put down a 10, 20, 30% down payment on the equity side, and then go out there and take a loan from the bank, right? To go out there and do it. Well, the capital stack is where all the capital is coming from. And it's usually equity. So, down payment from you as an individual investor, or, $2 million from limited partners. The other capital comes from a lender or a bank that's lending the money, and the equity and the loan adds up to 100%. Now, there's a few more nuances you get in there, but from a simplistic standpoint, this is being the bank. So when we say be the bank, we're talking about being on the side where you're loaning the money out. And this is where like private lending or hard money lending comes into play for a lot of investors. And so this is not your 30-year fixed mortgages. This is not like the long-term debt. This is for when people go out there and buy fix and flip. A lot of times they'll get a 6-month loan. Hey, I'm gonna buy the property. I got to close quickly to buy it off this motivated seller, and then I'm gonna fix it up and then hopefully sell by between month 6 to month 9. And it's a short-term loan. And so traditional lenders like your Chase Mortgages and your Castle and Cooks and these lenders, they don't do hard money lending. They do 30-year fixed stuff. So this is where, another part of lending comes in to fill the void, where they specialize in short-term lending. And so it's called hard money or private lending. And there's 2 ways you can be the bank from a simplistic standpoint is, Jeff's doing a flip right now. Hey, Jeff needs money. I can loan Jeff. How much money did you have to borrow for your last flip on the hard money loan? $600,000. Okay, I wish I had $600,000 to loan you, but I could loan Jeff $600,000 from myself to Jeff. Now I can get 10 to 12% interest on there, and usually 1 to 3 points in acquisition on there. So it can be a really good return. The problem for me is $600,000 is a big part of my net worth. If something goes sideways on there, that's more than 10% of my net worth into one deal. And then also I have to go out there and find the deal, and I have to go out there and then underwrite the deal, underwrite Jeff, which is not my specialty. And so it's not my area of specialty. The other option is you can go out there and rather than me lending directly to Jeff, so that's me going from private investor to the borrower Jeff, I can loan to a debt fund. And this is a hard money fund where they raise money from private investors, and then they go out there and loan that money to investors. But they're the ones who are underwriting the loans, finding the loans, doing the due diligence, managing the draws, and then they're doing all the work. Now, they lend the money to the real estate investment borrower. So a lot of times for fix and flips or a bridge loan for a bigger property. The borrower on the right side there pays interest, pays principal back to the hard money lender. Of course, they keep some of it to pay the employees and for their profit, and then they share the profits with the private investors. A lot of times they do quarterly distributions. And so I like this from an investing standpoint because usually, if you're the lender, you're at lower risk of losing your money than if you're out there putting your own money down the property on the equity side. And the reason I like the debt funds is 2 reasons. Is I don't have to go out there and do the work because my area of specialty is not finding properties to loan on and underwriting them. Secondly, if I invest $100,000, a lot of times that won't just go all to Jeff, but that will go across 30, 40, 50, 60, or 70 properties. So that money is lent across multiple properties with everyone else's money. So you have diversification because some of those properties will go into foreclosure. Not if, some will.
So understand that if it's, hey, if Jeff goes in foreclosure and it's $600,000, that's really bad news for me and Jeff. Now, if it's a fraction of that, hey, that's an easier thing to swallow. Does that make sense from a conceptual standpoint? Okay. So, one that we work with, and a good example is a group called Dynamo Capital. And here's a couple screenshots from their slide deck. Now, they're out of Wichita, Kansas. So this is not a Denver deal, but a lot of people, they want to diversify where all their money is because a lot of your net worth may be in a 30-mile radius on here. And also, other markets have other pros and cons to it. So we like the group, and we also like Wichita, Kansas, because it is a diverse economy. They've got some strong, corporations there, and they also have a big housing shortage, but it's also still very attractive for real estate investors. You guys know what the burrs are in single family? They still do burrs out there. I mean, hey, they buy a house, fix it up, keep it, refinance as a rental, and the numbers work. It's around the 1% rule, which we don't see in Denver anymore. And also, it's low lending competition. Since this is a smaller market, there's very few hard money lenders. So Dynamo has a bigger market share, and they also charge higher rates than we see here in Denver and a lot of other markets. And the other thing about them is they actually have 3 different types of loan products, which is not as common as we see in debt funds. One is a value-add loan. That's a fix and flip loan, which is very common. That's what most hard money lenders do. And so that's that 6 to 12 month short-term loan. The second part is they actually do some permanent financing, debt service coverage ratio loans, which are 20 to 30-year fixed mortgages, but they're not the traditional Fannie and Freddie. They're private investor notes. And so they originate those loans, which usually means they don't have to go out there and deploy their own capital, but they make a couple % on the loans. And that gets shared on to the investors as well. And then they take a small part of their loan portfolio and do opportunistic loans, like some, bigger land plays or other short-term loans where they can go out there and say, hey, this is just a really good deal to lend on, and we're going to charge the appropriate interest rates and points on there to, for the risk, but get some really good loans. So they have low competition in this market, and they have different loan products, and they share more of the fees on there. Yeah, go ahead. And so here's a really good example of how they work and other debt funds. They have a note, a promissory note, which non-accredited investors can invest in, and it pays 12 to 13%. And then there's the limited partner position, and it's targeting an 18% return, which is a little higher than normal. So that is where you can get on be on the debt side. And then this is pure cash on cash. There's no depreciation. There is no principal reduction. There's no stolen the property because you are the bank. You're investing on the bank on here. So this is, I think, very attractive. So most of my portfolio is in multifamily. The second is in debt funds because it's high cash on cash return and relatively liquid. For real estate, it's a 1 to 2 year lockup period, which is very common for, hard money funds. And so it's a good way to go out there and get cash flow in the market because, are many people getting 10% cash on cash returns for rental properties? No, unless you're renting out 6 bedrooms by itself or really on your short-term rental game. Most of the cash flow we see in Denver is, 2, 3, 4% with a 30% down payment. Not that exciting. So a great way to go out there and get cash flow. Any questions on the concept of a debt fund?
Yes.
I have a question that came from an investor actually today. How safe is investing in debt? Or in terms of a risk profile, how does investing in debt compare to, for example, the previous deal we just saw, which was the covered land play? How does that compare?
So great question. High level debt is usually a safer position. Because let's say, someone goes out there and buys a house and they put down a 5 or 10 or 20% down payment and they have to foreclose on there. So the first person to lose money is the person that put the money in there, which is the equity holder. Now that could be an individual in a single family home, or it could be 100 people investing in a 100-unit apartment building. They're going to be the first ones to lose the money on there. Banks generally don't lose money. Now in the current market conditions, sometimes they do on some of the deals they've done in the past. So you're usually in a much safer part of the capital stack. But this we have to get more nuance on there as well, because there's first position, there's second position. Most loans are in first position, which is a much safer than equity. But at the same time, you usually get a lower return because it is safer.
Any other questions on any of those deals?
So for the debt funds, it's like you can invest at any time. Like there's no,
Yeah, so this is great. So yeah, great question. So there's syndications and funds. So syndications are usually like a single asset, like we talked about with the Samuel Drive, the South Logan, all the 3 deals. Those are single asset. Hey, you're investing money, all goes in a single asset. So those usually have like a very short window of when they can invest in, and you know exactly what you're getting. Funds can be like a debt fund where they are open. Debt funds are usually open for a couple of years, and you can invest, anytime throughout there. Or if they're buying a multifamily fund, you may invest in the fund and they'll go out there and buy 10 multifamily properties. So I like funds a lot because you get more diversification. The downside is you don't know all the details, the exact asset you're getting. So there's trade-offs on there.
So they're not going to share what they're buying with their money.
Oh, they share with it. I mean, they share, but it's kind of a catch-22 where a lot of times like, I want to invest in the fund. Hey, I'll commit $100,000 to like a multifamily fund. Well, you don't know every single deal they're going to buy before you say, I'm going to invest in it. Now, as they go out there and acquire their properties, they'll share it with you, but they'll say, we're looking for properties that, meet this criteria, these numbers, this geographic location. So you kind of know what they're looking for, but you don't know the details like, we're buying 1000 South Logan. Now, debt fund, going back to the bank side, that's different because they're not buying the properties, they're lending it. And a lot of times debt funds will anywhere have like between like 50 to 200 loans out at any single time. It's pretty common from what I've seen. And so they're always, loaning money. Some loans are getting back. They're usually dealing with 1 or 2 foreclosures along the way as well. But with debt funds, you can usually invest anytime.
But are they going to actually share, say, like this quarter we invested in this property?
They usually don't give the exact addresses, but they'll share like the fund performance. Like, hey, we issued 19 loans to 11 investors. Here's the numbers. Here's this. Here's that. Now, if you like request it, they will share some addresses. But they usually don't share it all the time. But they share, hey, here's how it's performing, and they usually share like a monthly or quarterly report on how it's performing.
Kind of some of the benefit of the fund though is so you don't have to know those things. You're like, okay, I like this asset class. You go buy multifamilies. I don't want to do the deal analysis, and you have a good track record.
How does it guarantee the return?
So those are not. So the promissory note's guaranteed. They just know, hey, if we borrow at this and we can, lend at this. With the second position on there, it's a target return. It's not guaranteed. That's what they're targeting.
Right. So the first one is guaranteed, right? But what if, I don't know, the deals all go bad and then they cannot pay me back?
Well, I mean, so they're underlined. So a lot of promissory notes, they're guaranteed by the piece of real estate and also a personal guarantee from the lender or, from the lender as well.
So are they going to share their personal financials with me saying that they have enough money to pay me back?
You can ask for, yeah. But again, personal guarantees, personal guarantees are, take it with a grain of salt. But that's where also like the more important thing is like, hey, what type of properties you're lending on? And then that's where you have to learn, hey, there's certain industry averages like, you're lending at a 65%, loan to cost. You're targeting these metrics. And so you learn what they're lending on and you get comfortable with what they're lending on to make sure it makes sense.
But technically, when they give them the money, like they are not, like they haven't invested my money yet, which means that the deals kind of, like, I don't know exactly what kind of deal they're gonna get, right?
They have like a whole body of deals they're working on for these ones. For Dynamo, they're like funding fix and flips on a regular basis. And if you've been in the fix and flip business, I mean, a hard money loan now is like 18%. So if they're able to charge someone else that much, they can definitely give you 12%. That's kind of how the math works out there. High level.
And I think Dynamo, they usually have like 50 or 70 loans at a time. And so they have a pool of money that they're lending out. And this is where, they're usually turning like, oh, well, how do I get 14% when you're lending out 14%? Well, that's because they're turning the money 3 or 4 times a year. And so they get acquisition fees. They take some origination fees from the long-term financing. So they're actually making more money on there. Yeah. So the promissory notes are guaranteed. Again, that's usually you want to look for first position on the property. A lot of times with a personal guarantee. And the property position is way more important than the personal guarantee, in my opinion, because you're actually, lending on the asset. And then like the LP fund, that's a targeted return for, what they estimate they can hit. And they're pushing, north of 20 this year, but that again is not guaranteed and maybe higher, maybe lower next year.
So
But
you're saying they also guarantee the return with the property behind it? They also do that?
For the promissory note, yes.
Yeah. Okay.
Yeah.
So they're saying if I cannot pay back the money, you're going to get a piece of the property. So it's kind of
You won't get the piece of the property, but if you foreclose on,
You
yes.
foreclose
Yeah.
And then you got the money
Yeah.
from that.
And this again, where it's like, you're asking great questions. This is where it's good to go out there. We can send you the full deck on here. And also I'm a big fan of like Google and YouTube University to just start learning concepts on there as well. And I'm always a big fan of spend a lot of time learning, measure twice, cut once. And learn from different sources, talk to different people, go out there and learn how things operate. And then, hey, what's the industry norm for debt funds? What's the industry norm for deals like this? And then you want to make sure that, industry norm, a 2 to 3% foreclosure rate. And then, oh, you're lending at 99%, loan to value. That's really high. What's the industry norm on there?
But generally, our goal of today was to just give you a high level of, there's a ton of different types of funds. When you go to that portion of deal evaluation and analysis, this is the information you should get, but you should go way deeper. This is probably a 30 slide deck that we pulled from for this. Yeah. So we tried to we ran through not a lot of details for each of these just to give you the salient points because everyone's investment thesis is different. We didn't want to go too deep.
So if you guys have any questions, obviously we do some of these deals. If you invest in the deal, we will make money off of there, assuming things go well. But at the same time, we are big believers in adding value through education and helping people figure things out. So if you guys have any questions in general, we're always happy to sit down and do a strategy call or a strategy, cup of coffee.
These are strategy call QRs.
Yeah, that'll go to our Calendly's. So you can go book on there. So we're happy to talk about it. And we try to do our best of giving value and giving, hey, here's the options out there. And then, hey, if we do a deal, awesome. If you guys, are looking to ever buy a rental around town, I would definitely talk with Paige as well. She's still active in doing rentals around here. I'm more focused on the bigger deals now, and Paige is transitioning that way as well. But yeah, if any questions, book with us, or we can always catch up later tonight as well. So, what questions do you guys have?
We answered all of them.
So, if you're a GP and you're also investing in the property, do you get that preferred return that's along with the LPs before the split?
Typically, no, because you are keeping all the waterfall as well. So it kind of depends how they structure it. But the biggest thing is you just want to see hey, that's called a co-invest. Do they have money in the deal? If anyone's ever putting together a deal and they're not putting their own money in the deal, to me, that's a huge red flag.
It's kind of just good faith.
Yeah. And usually you'll see anywhere from 2 to 5% is a very common co-invest amount. Sometimes a little higher, but 2 to 5% is the most common number you see out there for they're investing alongside. Now it happens since they're kind of investing money also the GP, the waterfall doesn't really apply to them because they get, both sides of the return. So they're slightly different in the way the classes are structured, but conceptually it's about the same.
Sweet. Well, there's more White Claws if anyone wants. And
you can't get rid of those, huh?
No one will drink them. Everyone switched to water. Sober-tober. But yeah, thank you, everyone. We really appreciate you coming out.